Tractor Supply is undervalued, but is it a buy now and at what price? We're going to find all the answers to these in today's episode. We're going to take a look at the historical performance of the company. We're going to, as always, deep dive into their income statement, their revenue progression over the last 5 years, look at that balance sheet, compare their total cash to their total debt, and we're going to take a look at that dividend safety. Can they continue paying nice dividend increases? How are those financial metrics looking on the free cash flow and other important details? And we're going to run it through our stock valuation. What is the true intrinsic value? And given our margin of safety, what is our acceptable buy price? Now, Tractor Supply Company is relatively flat year to date with just a decrease of just under 1%. It offers a starting yield of 1.86% and is currently in the middle of that 52-week range. Now, for those shareholders who have been holding the company for the last 10 years, they have seen some very, very nice growth, 272% in share price appreciation. That does not include the reinvestment of that yield at 1.86%. So historically, a very nice stock. Now, taking a look at that income statement over the last 5 years, we like to see around 3 to 7% revenue growth year on year. And what we can see here is in December 2018, they reported just under 8 billion. And 5 years later, they reported just under double that at 14.2 billion. So very nice, consistent year-on-year growth. I'm liking what I'm seeing at the moment. Now we want to take a look and see how that has affected that bottom line. Now, December 2018, they reported net income of 532 million. And 5 years later, almost just over double that at 1.1 billion. So very nice to see the growth year on year. So positive so far. Now I want to take a look at their balance sheet and in specific look at their cash versus their total debt. So we can see their total cash as well as their short-term investments in 2018 was 90 million, just under 90 million. And in their latest quarterly report, this is sitting around over double at 190 million. So nice growth over the last 5 years. We can see it increase and then decrease, but from 5 years, we can see a nice picture of increasing over that period. Now, looking at their total debt, what we can see here is their total debt has gone from December 2018, 440 million, and has shot up quite incredibly to more than 10 times at 4.7 billion. Now, this is a potential red flag indicator, and when we look at our dividend metrics and our other financial metrics, we're going to see if they are continually able to pay that dividend, and we're going to see if they can pay down that interest and debt. Now, their dividend safety, a score of 68, meaning it's safe, and a market cap at 24.2 billion, making it a large cap and showing signs that it can grow. Now, key metrics, just to point out a few. Dividend streak, they have been paying dividends 12 years without a reduction. No dividend was paid in the recession period. However, their recession sales was plus 6%, which was above the average growth in the last recession, which was in fact negative growth. And it beats the S&P 500 return of negative 55% in that recession period, although it was negative itself. Now, dividend growth, we like to see 4% increases in our dividends, in our salaries, in our other income producing assets, as essentially the US inflation rate over the last 40 years was 4%. So if you're getting less, you are losing your purchasing power and in fact getting a pay cut. 12 years consecutive increases, as mentioned earlier, very nice to see. Double-digit dividend increases is beautiful. 12% in February 23, 29% over the last 5 years, and 26% over the last 10 years. Now, I can tell you 26% growth year on year is absolutely incredible, and I'm not sure that many people would be able to say that their salary increased 26% year on year. So, very nice growth to see. Now, dividend yield theory states that a company is undervalued when the current yield is sitting above the 5-year average. So this points to undervaluation. However, we don't look at any model in isolation, so let's draw our conclusions at the end of the video. Forward PE slightly lower than the 5-year average, so again, another sign of undervaluation. However, the sector PE is sitting at 14 with Tractor Supply at 20.8, so this could be a sign of overvaluation. And more for information purposes only, it is sitting in the middle of that 52-week price range. However, if it was at the bottom, it wouldn't mean it's undervalued. Likewise, it wouldn't mean it's overvalued if it's sitting at the top. Earnings payout ratio, I prefer to look at the free cash flow payout ratio, as the earnings is susceptible to manipulation through accounting. But for both, I like to see below 60%. For those looking at the earnings payout, every year on year has been below 60%, around 38, 39% for 2023. However, for the free cash flow payout, we can see a truer picture, in my opinion. In 2022, it was at 70%. A slight red flag indicator only if you are expecting double-digit dividend increases. However, 2023, it is expected to drop back down below 60% at 49%. So that is positive to see. And in my opinion, as a whole, nothing really to worry about here. Likewise, I do prefer to look at the free cash flow per share. But for those that like the EPS, we can see nice growth year on year, with 2023 expected to be 10.6. So very positive. Likewise, with the free cash flow per share, 83 cents in 2013, 5.24 in 2022, and is expected to increase quite significantly in 2023 to 8.48. Now, this is why I like to look at least a minimum of 10 years worth of data, because if you were just to look at, say, 2019 to 2022, you would not have a true sense of the business. So far, so good, very positive in my opinion. Sales growth, as I mentioned earlier, 3 to 7% year on year, and they have essentially smashed that across the year, across the last 10 years. And we can see here in 2013, they had around 5 billion worth of sales. 2022, almost 3 times as much as 14 billion. So if this does continue, this is very, very positive. Shares outstanding, I think what's nice to see is that they are consistently returning excess cash to shareholders by performing share buybacks year on year. So very nice to see. It's not a significant amount, but it is fairly constant, which is positive. And then we move on to the ROIC, which is lovely. If you have seen my YouTube pinned video, I do discuss my 7 golden dividend metrics when selecting stocks that I personally purchase. Return on invested capital is 1, so do go check that out. We look for a minimum of 10%, as this means management are able to effectively manage and allocate their capital. So we can see here the last few years around the 20s, very, very positive to see indeed. Now, operating margin, I do like to see around 12% plus. However, given they are around that at 10% for the majority of the last 10 years, and they have been performing very well in the other areas, this is not a significant worry. One area where I would like to see them perform slightly better is around their free cash flow margin. Fairly inconsistent and hasn't really gone above that 5% that we like to see, especially in the last couple of years. So this is something I would be looking for in their next annual report. Now, the net debt to earnings before interest, tax, depreciation, amortization, I did flag this earlier due to the balance sheet and the high increase in their total debt level. However, given from 2020 for the last 3 years, with expected 2023 to be well below that 3, it doesn't look like it's going to be an issue, but it is one just to look out for in their next annual report. Essentially saying in 2022, it would take Tractor Supply 1.77 years to pay off all its debt net of cash on hand. This one, just more for information purposes, 2022, 67% of the company's financing was from debt as opposed to equity. Now, if you're enjoying the content, do smash that like button. If you're getting value from this, do hit the subscribe button to get more content and continue the train of content. Now, the stock valuation model, if you want to grab this, do check the pinned comment and you can run your own companies through these models. And if you want to join us on Patreon, again, do check the pinned description. Now, Graham's valuation, we have the earnings per share at $10, the growth rate at 12 as expected by analyst estimates, with the current yield on AAA corporate bond. This gives an intrinsic value of $176, and we can see here this is right at that 52-week low. Multiples valuation, we have companies in a similar sector and industry. We have Home Depot, Lowe's, and Caterpillar. Once we input the stock price and EPS, we have the P multiple, of which we get the average multiplied by the earnings per share to get a price based on the multiple valuation at $192.58. Again, lower than the current trading price. Now, the DDM model, dividend discount model, once we have our yearly dividends, we can see the average growth rate year on year at 30% over the last 5 years, which is very, very nice to see. We can see here the growth rate. I've gone for slightly lower than the last 5 years, just to be a bit more on the conservative side if we do head into a recession. And this gives a DDM price of $292. higher than the current trading price and above that 52-week high. The final model, the DCF model, the discounted cash flow model, we input the free cash flows year on year. We then have the growth rate year on year, of which the average is 31%. We've gone for a growth rate slightly lower than the average growth rate, a bit more on the conservative side. And using our discount rate, we get the present value of these future free cash flows alongside that terminal value. Once we add this together with the cash and cash equivalents, subtract the total debt, we arrive at our equity value. Divided by the shares outstanding, the DCF price comes in at a nice $304. Now, as always, do hit that like button if you are enjoying the content and do subscribe to continue our journey. Now, we can see here the 4 models that we have just run through. The intrinsic value is essentially the average of these 4, coming in at $241. Now, do let me know your thoughts in the comments if you're shareholders or if you're on the sidelines looking to enter. Typically, I look for a margin of safety around 10% for strong companies, wide moats with nice historical data and good forward-looking guidance. Now, margin of safety for Tractor Supply, you'd be looking to buy around $217, which is essentially a few dollars shy of the current trading price. Now, it would be justified if you did want a higher margin of safety for a company like Tractor Supply at 20%, and your buy price would be around $193, which we can see here is slightly higher than that 52-week low. Now, Wall Street forecast the price over the next 12 months to reach $258, showing some nice upside to that current share price. As always, let me know your thoughts in the comments. Are you looking to buy or sell? And as always, have a lovely, lovely day. Catch you on the next episode. And don't forget to smash that like button.